Morning, everybody. Thanks for joining us. My name is Bill Sansoni. I am the team leader for law firm services at the firm. My background is a little bit on helping law firms with their business and strategic planning, and also with their practice management issues. So I think this is a really good topic in which we're that's new and it's going to be effective against the firms today. Joining me is my partner, Paul Gergel. He's the team leader for professional services. And I also have Marcus Dyer. He's a tax attorney here who's the team leader for the tax controversy niche in the firm. And he's going to give you a little bit of background on the specifics of the law. So let's just jump in. And so what I'm hoping to cover, well, we're hoping to cover today in the brief 20 to 30 minutes here is a bit of an overview of how the new tax law affects the meals and entertainment expenses. I just want to also bring to your attention that if there's a little chat box that you'll see. So if you want to ask us any questions as we're going along, just type in your question and we'll get to it. And also there's a little handout section. So you'll see that we have a little bit of an outline there to give you a little guidance as to go along with this as well. So hopefully you'll find that useful. So what are we going to cover today? We're going to try to give you a little bit of an overview on the new rules for meals and entertainment. I mean, we realize that there's supposed to be some tax simplification here, but when we kind of go through some of these things in some real life cases here, I think you're gonna find that your head's gonna be spinning a little bit as to what all the different issues here that come into play. I think Marcus is going to give you a little bit of general guidelines as to some of what the rules are. I think Paul and I are going to give you a little bit of a lightning round issue as to some real life case scenarios in which you may be feeling within your firm right now, and then we're going to just give you a little input as to what we hear in the marketplace, what some of the things that are going on. So let's get to it, okay? So December 22nd, we get the Tax Cut and Jobs Act signed by the president, and one of the things that we realized out of the box, his goal was to cut taxes and to try to simplify things. But again, I think what you'll find is that given all these new rules that we're about to go through, that simplification is the least of what happened. We've already done a number of seminars with some law firms on the tax update, and I will say the most interaction that we had during those seminars was regarding this particular topic. So hopefully that's why we just wanted to spend about 20 minutes with you, just to try to give you an update and on this, tell you what some of the tasks are at hand for you, that some immediate things that you're going to need to do, and then how we can help you, to get through some of these challenges. So what's the issues at hand? So I'm going to break it down pretty much as there's three areas that you want to think about. So if you're somebody on the phone here that's the CFO, the controller, or somebody in the accounting department, or somebody that has something to do with the budgeting and tax projections for the firm, I think that this is probably something that's going to pique your interest a little bit. Number one, for those in the accounting department, what's going to be required now under the meals and entertainment rules is you're probably going to, in your chart of accounts, you're going to have to set up new buckets of all different expenses, and all these categories are going to be set up based upon 100% deductibility, 50% deductibility, or no deductibility. And what kind of makes this a little challenging is that even though you're going to go in and create these accounts, what you're going to find here is that you're going to have to go retro back to January 1st. So now we're in, it's March 9th. We're going to have to go back at least 2 months to kind of reclassify a lot of these things. Number two, you've now set up all these new categories. Probably most of you have been in handling your expense reports pretty much the same way for the longest of time. Somebody's probably created it on an Excel worksheet, or somebody on a handwritten form. Some people might have just taken their, credit card bills and just somebody's kind of broken out the expenses. Well, you're going to now have to tie out those expense reports based upon your new accounting buckets and really on how the deductibility is towards taxes. So there's point number 2 at hand. You know, 1 is setting up the bucket, 2, setting up the expense report, or the way to capture all this information. And I think number 3, which is going to be a challenge, is, you know, you're going to have to educate all the people that are filling out all these forms as to when they go to an event, why it has to be, you know, documented this way, or hey, this is deductible, or hey, this isn't deductible. So it creates a little bit of a challenge, and as we chat a little bit later on, you may find that, you know, it's not going to affect how you're going about doing business, because, you know, from a tax perspective, it's not going to matter. But for some people, it may have an impact and an effect. So with that little intro and what's at hand, I'm going to turn it over to Marcus, and he's going to give you a little bit more specifics in regards to the rules and regulations with meals and entertainment. Marcus?
Great. Thank you, Bill. That was very informative. As Bill stated, I used to practice law, so I'm fully aware of the challenges and travails of being an attorney and constantly having to interpret the law. And so hopefully in this next piece that I talk about, I can clear up some confusion, at least as it pertains to meals and entertainment expenses under the Tax Cuts and Jobs Act. So the first type of meal and entertainment expense I'd like to discuss are the entertainment expenses. You used to be able to go to the Phillies game, the Yankees game, out on a yacht or on a sailboat and write that expense off, at least in part. In the past, you could deduct up to 50% of these costs. Under the Tax Cuts and Jobs Act, there is no longer a deduction for these types of expenses. So what is an entertainment expense? They are defined as an activity generally considered to be entertainment, amusement, or recreation. So it's about having fun. It includes entertaining at nightclubs, theaters, sporting events, yachts, going out on a sailboat, even adventure trips. It includes membership dues with respect to your favorite, clubs organized for business, pleasure, recreational, social purposes. It also includes a facility or a portion thereof used in connection with any of the above items. So this is significant. If you're going out to the golf course now to cut a business deal, there's no write-off. Now, you may be able to deduct the travel of getting out to the golf course, but you cannot write off the activity of playing golf. Now, note, the fact and the fact pattern that I just gave you of cutting a business deal is key. That's a business purpose. Generally, travel to an entertainment activity is non-deductible. Some creative clients have asked us whether they can just simply reclassify their entertainment expenses as marketing. Be careful with this strategy. The IRS does scrutinize meals and entertainment expenses. They examine who provided the goods or services shown on a receipt. If the receipt is from a company known for entertainment, the IRS will deny the deduction. Now, not all entertainment expenses were eliminated. The following remain deductible. Certain entertainment expenses for goods, services, and facilities that are treated as compensation to an employee. Expenses for entertainment sold to customers. And don't worry, taxpayers may still generally deduct 50% of food and beverage expenses associated with operating their trade or business. Let me elaborate. First, let's look at employer-provided meals. This includes meals provided for the convenience of the employer, meals provided to employees occasionally, and overtime meals, water, coffee, and snacks at the office. There was food that we could write off 100% under prior law. We could write off 100% of food if you bought food for an office staff meeting. You got 100% write-off for office purchases of donuts on Friday mornings, drinks in the fridge, bagels on Thursdays. These are known as de minimis meals provided for the convenience of the employer. Effective January 1, 2018, business deductions for de minimis meals provided for the convenience of the employer is limited to 50%. And please remember, even meals for those associates working overtime preparing for trial are limited to 50%. Now, this 50% deduction is scheduled to be completely eliminated as of January 1, 2026. And this rule does not apply to food for customers. Next, let's look at the business meals. Now, the IRS is not happy with how business meals are treated under the Tax Cuts and Jobs Act. They've been fighting to eliminate this deduction since the Carter administration. You may still deduct 50% of the costs for business meals, whether you are just going to lunch with a prospect or a customer. So there has been no change from prior law with respect to business meals. Make sure you still have a business discussion before, during, or after the meal, however. Now, some of you may be wondering, what if I take my client out to a game and buy food? Does the meal fall under entertainment or a business meal expense classification? The answer is the former. A meal enjoyed during an entertainment activity is deemed a part of entertainment and non-deductible. Now, some will look for a loophole and designate meals and entertainment as marketing expenses. But again, be very careful about that. Now, there are some expenses that have been and continue to be 100% deductible. And these are meals sold to customers and meal expenses for company events. Okay, so next let's talk a little bit about what you have to show in order to be entitled to take a deduction for a meals or entertainment expense. First, I'd like to say all expenses, in order to be deductible, are subject to the rules of Section 162. How could I get this one mixed up? Section 162 of the Internal Revenue Code. It provides, in essence, that for an expense to be deductible as a business expense, it must be ordinary and necessary. The same applies to meals and entertainment expenses. But there are additional rules that apply, and those can be found under Section 274 of the Internal Revenue Code and the related Treasury regulations. And what those provisions of the code require is that you show for any meal or entertainment expenses the amount of the expenditure, the time, date, and place of the expenditure, and the purpose of the expenditure. Now, these records should be contemporaneously kept, and unlike other business deductions, they must be in writing, so you can't go to tax court and provide oral testimony as to what your deductions were and the expenses you should be entitled to. If you don't have these deductions in writing and with the specificity that I just indicated, they are non-deductible. And another thing that you should take into consideration when you're going through your substantiation rules is that you're going to have a category for entertainment meals, and I believe that's even in the Act, in the Tax Cuts and Jobs Act. So now you're going to have to distinguish between meals that you have in the entertainment context for meals that you have in the business-related context when you're taking out, customers and prospects. Okay, so that's it for my piece.
All right, thanks. So I just want to remind everybody there is a handout, and if you click on the handout, it's broken down into 3 different categories between fully deductible, non-deductible, 50%. We put in quite a few examples, and I think that one of the things that's kind of important is, when you're considering the categories in which you're putting things in, which stuff is private or limited versus public or not. So I'm going to turn it over at this point over to my partner Paul Gergel, and he's going to kind of bring up some, how this is going to, or how we envision this whole thing's going to work in the real world.
Actually, before we start, and just a reminder before Paul starts his piece, I see some people have their hands raised. If you have any questions, please send them to us in the chat box. It's private, so not everyone will see it, just we will. But that's how we're going to be able to answer those questions. Thanks.
Great. Thanks, Brooke, and thanks, Bill. Because after all, we do all work in the real world, so we thought it'd be great to go over some real-life scenarios. So I'm going to fire off about 12 or 13 of these and to Bill Sansone, and he's going to tell us whether the firm would get all, half, or none of the deduction. So number 1, I take a client to a Yankees game. Tickets, deductible?
No, Paul, 0.
All right. What if I buy him a few beers and a hot dog at the game?
Nope, the new rules say food at the stadium is still part of entertainment.
Still no, huh?
Yeah.
After the game, we go to one of my favorite restaurants in the city, Del Frisco's, and we talk a little shop. What about that?
Well, that hasn't changed. That's still 50%.
All right, good. And the next day, we're still whooping it up. We're going to go to our favorite TPC club for a round of golf.
Yeah, that's no longer deductible, 0.
Okay. So switching gears a little bit, going to throw a holiday party for my firm. What is that?
Well, if it's for the firm, that's 100%.
Okay. We had a really good year at my firm. We're going to have a special holiday party for just the senior partners so we can pat each other on the back. What do you think?
That's going to be 0. The reason why is that discriminates, whereas with the original one that you asked me about the firm, that included everybody. That was 100%. But because this discriminates, it's 0.
Got it. Got it. Now, my firm has a really big case, and everyone's working through the night, and I got to feed them. What about the meals?
Well, that used to be 100% because since it was for the convenience of the employer, they now changed that rule down to 50%.
Okay. And every Thursday, Friday, we buy our employees donuts, bagels. Every day we're providing them water, soda, coffee. What about that? I used to get 100 for that.
Yeah, that used to be 100. Huh? New rules say 50%.
Okay. What about the pantry we keep at the front conference area? It's for the public, for my clients as they come in. We provide them with water, coffee, and snacks.
Well, it's interesting you asked that because if you put that in the employee cafeteria, it isn't deductible. But if it's for or 50% deductible, but if it's open to the public, it's 100%.
Oh, okay, great. Switching gears again, what about travel? So my firm puts me on a plane to California to work on a case. Can I get a deduction for the meals while I'm out of town?
That rule hasn't changed. Staying under the old 50%.
Okay. Well, what if I bill it to a client that I'm working on out there?
It's 100% then.
Okay, good. Now at our firm with them, we hold a CPE, an annual CPE for our clients. where we provide them breakfast and lunch. Am I going to be limited on that?
Nope, that's 100% because that's offered to the public. Everybody gets offered that.
Yeah. Okay, good. Some of the bigger firms out there, they sponsor a suite at a stadium for a charity event, where it's a mix. The price is kind of a mix between the ticket price and a charitable element too. What about that?
Well, part of that is non-deductible. That would be the actual cost of the tickets for the event, et cetera. But anything paid above that, that would probably be considered an advertising or a marketing expense, or maybe, depending on who it's going to, a charitable deduction. So part of that would get 100% deductible, and then the other part would be zero.
Great. Okay. That's it for the lightning round. I know we have a question or two coming in, but I just want to close my section here with talking about what the marketplace is saying. Hopefully at this point in the webinar, everybody out there realizes that a tax deduction for all the fun stuff is gone. The IRS is not fun, and they're going to try to limit our fun too. So sporting events, concerts, the luxury skybox suites, all the fun stuff. The meals, while you're at all these fun things, gone, gone, gone. Suddenly, entertaining our clients got a lot more expensive. The impact, I think, is going to be felt most at the smaller firms. The big firms are going to keep doing what they're doing because it's part of the job, and it's an element of getting new business. But I feel small firms are going to need to assess the impact on their bottom line. Unfortunately, Congress preserved the most common way firms can entertain and still get a partial deduction, and that's meals at restaurants. So smaller firms may want to consider scaling back on the golf outings or the sporting events in favor of entertaining at restaurants. Maybe hotels will expand the free meals and include that as part of the lodging costs to help the smaller guys out too. So that's it. I do see a question or two coming in. Marcus, you want to?
Okay, should I read the question? Mm-hmm. All right, thanks. So thank you, Paul. The handout says bagels and donuts are fully deductible, but the lecturer said they are only 50%. Can you please confirm? Well, audience member, the answer to your question turns on for whom the bagels or donuts are purchased. If they're for your employees, then for some type of staff meeting or something along those lines, then they're going to be 50% deductible. If they are for your clients or customers, or as Bill said, open, for the public, then they are going to be 100% deductible.
Great, great. And I got another one. I'm going to direct this one to Bill. Here's the question. The P&L my controller gives me has just one general ledger account called Meals and Entertainment. How many new accounts does she need to establish as a result of this new tax act?
Okay, so I guess the answer to that question depends on the activity within the law firm. But what I would say is that, for example, let's talk about meals. You're probably going to have to set up 3 to 4 different categories for meals, depending on, which ones are meals for entertainment, which ones are meals for employees, which one are meals for the office. So there's all different categories, and depending on how much you drill down would really require you how many new account line items you need. Also, same thing under entertainment. What items are, what are getting charged to clients, which is important, which ones are not getting charged to clients, which ones are for, really to take people out versus really for a different type of dialogue, more specific. But what I would add to that also is, in the market, if you're a professional corporation, some law firms are professional corporations. When we're talking about the loss of some of these deductions, one thing I want you to keep in mind, and I've run this number for a couple of PCs already, using their 2017 numbers, is that, the rate for 2018 on professional corporations are going to drop from 35% to 21%. So even though you may be losing these deductions, for example, if you had Yankee tickets or Devil tickets or Phillies tickets or Eagles tickets or whatever, and you may be losing those deductions, the loss of those deductions really don't, because of the reduction of rate, your net tax effect probably, it wouldn't matter. So really what it comes down to is really management focusing in on, are these expenses good, a good source of goodwill or marketing to keep our clients happy or to generate new business, et cetera. So that's something that you have to waver about and think about as well.
I noticed we have one more question came in. I'm going to direct this one to Marcus. The question is, I take a client to a jazz club for dinner where entertainment is also provided. What, if any, of that is deductible?
Jazz club for dinner and entertainment is provided. Generally, that's going to be non-deductible. Can't do it. Some creative tax planners may try to find ways to make that deductible by, talking up the business component of it, really having a very in-depth, conversation about business, or trying to really market, their company. But in general, it's going to be non-deductible and treated as an entertainment expense.
Great. Thank you. Oh, I'm sorry. One more just came in at the bell. Can you please detail again the information we have to show in the expense reports for meals and entertainment? That one's, I think, directed to you, Bill.
Say it one more time.
Can you please detail once again the information that we need to show in expense reports for meals and entertainment? I assume that's like proper documentation.
Right. So the when you're putting through the expenditure, the documentation, what is it for? When we chatted a little bit about the purpose of what we're taking a client out for. Hey, we just finished the job. We're taking you out to dinner. You have to kind of like earmark that in the specific section. And again, you create an account within your ledger account as to how that gets posted. If it, when it's a proposal, again, you have to state in there it's a proposal. When you're taking out staff for a job well done, you have to state in there it's for a job well done. That you're not talking about while the job is still running, that the reason why you're taking, as crazy as this may sound, I take my staff out in the middle of the job because we're talking about the status of the job and getting it through. It's not deductible. If I take them out at the end of the job and say, you guys did a great job, it's 100% deductible. So therefore, you have to write in the description, as crazy as this sounds, that's why this is not tax simplification, kind of saying, what is the purpose and why we're doing that and why it's posted to this bucket versus the deductible bucket versus the non-deductible bucket.
Right. That's the reason that companies really need to reassess the general ledger accounts that these things are being posted to and the time and expense reporting program that they use to make sure that they're in sync, so that you don't want a big mess at the end of the year. You want to do this contemporaneously. And so now's the time to look at it. Otherwise, it's going to be a very burdensome task a year from now when everybody's getting ready to do their taxes.
So I want to thank you all for joining us. I hope you found this pretty informative. And what we're kind of hoping is that, this kind of piques your interest a little bit, and we're here to help you. So if you needed somebody, you could reach out to myself, Paul, or Marcus, or if you have another contact with the firm. If you need us to come out, maybe sit down, have a discussion with your controller, CFO, whatever, about what buckets or what accounts need to set up. Maybe, hey, do you have a couple of ideas of how we could formulate our expense reports that they tie out to the general ledger? And, we'd be more than happy to also be part of the educational process with your staff so that we understand that sometimes when they hear from an outside, it's kind of like kids who, when they hear from somebody other than their parents, they kind of pay attention. So, we'd be happy to come out and do that. So any feedback that you have for us would be great. A reminder that, You do have the handout that's part of the package. And, again, if you need to reach out to us, our contact information is there. You'll see my card, Paul's card, and Marcus's card as well. So again, thank you very much, and enjoy the rest of your day.